Thank you, our viewers, for always making it a point to watch each and every episode that we upload on YouTube. I would love to welcome you yet again to our extended episode about collective investment schemes. So today we just want to focus on the power of compounding. Unit trusts are being sold on this market against the principle of compounding, but most people do not understand what compounding is. So there are two forms of interest. For you to understand what compounding is, I need to first explain to you what simple interest is. So simple interest is where you get, say for example, 10 million, you invest it somewhere, and at the end of that day, it is going to give you, if say for example the rate is 11.6, it's going to give you 1,160,000 at the end of the year. That is, those are per annum rates. So that is very simple interest. It means the interest comes out as is. So now that we know what simple interest is, compound interest on the other hand is basically whatever is left on your investment account every day earns you more money. So where you have 10 million that you've invested and it has earned you 1,000 today, the next day it's going to be earning you 1,200 because the amount of money that is on your investment account has increased. So compounding interest is basically having everything that you hold earning you interest as per interest declaration date. So your holding value is calculated and it earns you interest for you to be able to move to what you'd call the different options of interest. So there's compounding interest and then there's simple interest. So now that we understand compounding interest, let's jump into a little bit what it means when you invest into a unit trust. So compound interest is really money that has been earned off whatever it is that you're holding. So going back to our example where you're saying someone has invested 10 million, you invest 10 million, that money is going to keep accumulating. By the end of the year, you'll have slightly more. So an investor who has invested into a unit trust will have their money compound. And a wise man once said that compounding interest is the eighth wonder of the world. He that understands it earns it. He that doesn't understand it pays it. That is Albert Einstein. So if you look at the calculation of the different movement of compounding interest, someone has invested 10 million in month one. If you, for example, invested in a fund like the Britam umbrella fund, which returns an average of 11.6, 11.7. So you've invested 10 million. In month one, you're going to see your money earning you 96,000. So that 96,000 is the interest you've earned over 30 days. In month two, that money will increase to go to 97,000. In month three, it will go to 98,000. In month 4, it will go to about 99,000. And in month 5, it will be 100,000. By the time you close the year, month-on-month interest, it will be 107,000. So if you look at it, by the time the year's ended, you've earned 11.2 million. So your interest then that has been earned is 1.2 because the money has grown. So the movement from 96 to 107 month on month is what you'd call compounding. So your money then gets to be added on. So the interest for last month becomes part of the interest for this month. The interest for this month then becomes a part of the interest for the other month. And really that's basically what compounding does. That is the power of compounding. So those figures look like they're small figures, incidentally, for our investors. They look like they are figures that you can just discard. Every time you think about discarding the 96,000 against your 10 million, remember there is inflation. So you look at someone who has the same amount of money and someone who doesn't have, who has invested that same amount of money in a unit trust. A person who has invested in a unit trust that is returning an average of 11.6, by the end of 10 years, the money will have accumulated to 31 million. The person who has 10 million and has not invested it anywhere, at the end of 10 years, with an average inflation rate of 3.5, will have lost about 2.7 of their money to inflation. So do you want to tell me that you rather lose 2 point something million from your 10 million than get 97,000 that is going to keep growing without you adding any money into that pool of money. So for me, really, here today, it's for us to accept that compounding is not something you can run away from. If you run away from it as an investor, I would love to say that the small moves really are the ones that are going to get you the bigger cake. So you start today investing your money, small amounts of money. At the end of a few years, your money has grown. Your money has been reserved in terms of capital reservation away from inflation, and everyone is happy. Okay? So another thing that I think I want us to just delve in as we close this discussion of Pesa Talk is the corporate governance structure of unit trusts. So corporate governance is very key. We oftentimes tell you to invest into unit trusts, but the skepticism around how is my money safe? How do I ensure my money is there? How do I ensure that I hold you accountable as a fund manager? So first of all, unit trusts are licensed and regulated by the Capital Markets Authority of Uganda. So this is the regulator that sits at the helm of the corporate structure of unit trusts, or what you call collective investment schemes. For the Capital Markets Authority, their mandate is to ensure that your monies are safe. We're investing as per our investment policy statement, that your money is not going into spaces that have not licensed us to invest in. The second person that is very important in this framework is the trustee. The trustee is normally a bank. Most fund managers have banks as their trustees. In this case, on the market, KCB has been one of those trustees that you see on most of the unit trusts that we currently run. So the trustee really is the eyes of the regulator on the ground, and they're the eyes of the unit holders on the ground. These ones just ensure that we are doing the right things, that your money is also put in the safe investments, that your money do not go out of the places where we've told them we're also going to invest. So these ones ensure that your money is safe. Theirs is to safeguard your money, to hold us accountable, to hold all of us, the service providers, in the framework of collective investment schemes governance structure, very accountable. And of course, the other is the custodian. So custodian is also normally a bank. The custodian is the one that ensures that your assets are safe. So assets can be cash. So every time you're going to invest into a unit trust, the account that is given to you is in a custody account. And currently on the market, we have Stanbic that runs custody for example, the Britam funds. We have Stanbic and Standard Chartered Bank. So these ones collect your cash. They ensure that when we've bought the assets for the different funds, they are in safe custody, and that's what they do. So that really just ensures as a segregation of duty. And of course, the last one would be the fund manager in terms of this framework. The fund manager, you have CFAs, you have people that are professionals. These ones, their work is to scout and look out for the best offers on the market, the ones that are going to give you the best returns, the ones that are going to be very safe for your returns, and theirs is to make the investment decisions. And once they do that, you're able to make a good return, because one, they've offered the expertise as fund managers, and they are able to give you very modest and competitive returns on the market. Over and above that, most unit trusts, or all unit trusts, undergo a process that we call an audit process. That process normally looks at what the funds are investing in, how the unit holders' monies are being invested, that movement, generally an audit structure. Audit is just to ensure that we are playing by the terms we've said we will play at, and that audit normally happens, and financials for the different funds are published in a gazetted newspaper, mostly New Vision, Daily Monitor, Trade and Finance. You see those financials for the different funds by the different fund managers. That is still part of the corporate governance and legal framework, that fund managers are by law required to have an audit at the end of each financial year, which is 31st December. That audit closes their books for that year, and they declare the state in which each of the different funds are. Over and above that, on a micro level, most of us, the fund managers on this market, run apps where you can go and monitor your investments over an app. You can generate a statement for yourself just to give you comfort that your money is there. If you do not get the app for you to be able to look at how your investment is growing, all of us as fund managers run automated monthly statements just to try and ensure that we are very open and accountable to you. So at the end of the month, we share with you a statement that just shows your holding, how much your money has earned, and where we are headed. Again, over and above that, on a micro space, all of us as fund managers, or majority of us as fund managers, publish and send out what we call fact sheets. Fact sheets just show you how these funds have been performing over time, where they've invested, what you need to know in terms of the management fees or the fees that are there that are charged by the different fund managers. For you as an investor, you need to be reminded. It's like a know your fund kind of document. It's a fact sheet. It shows you if your fund is growing, if your fund is not growing, the fund that you belong to should be able to grow month in, month out. So those are also sent out for you. And what is very important for you to note as an investor in a unit trust is that your fund manager is going to organize an AGM. And at that AGM, you are welcome as an investor to come and attend. Most of the fund managers on the market do what you call hybrid AGMs. So you have some people coming in physically, some people are online. What happens at the AGM is just communication from the different service providers. You have the custodian, you have the trustee, you have representative from the regulator, you have board members from the different fund manager board committees just coming in to give you, the investors, accountability in terms of how your funds are performed over that period. So really, for you who is still skeptical about investing in unit trusts, after watching this episode today, you should be able to know that your money is safe. How safe? One, there's a bit of openness in terms of the different fund managers. They try and be open in terms of their dealings and communicating proactively to you, the fund managers, decisions in terms of where they're investing your money, such that you have visibility of what your money is doing and where it is headed. So looking at that framework, you really should be comfortable to make that decision today to move that cash that you're keeping under the bed into a unit trust account. You just need to choose which one is the best. You can talk to someone at Britam. We have multiple financial advisors placed across Uganda. You can talk to someone just to try and understand which product fits your investor profile. So from me, again, as we close today, I would love to say I thank you for keeping it with me today on Pesa Talk. I appreciate your time. I do not take this for granted. I would also love to give props to our production and marketing team, that is Vadi Media and Brandforge, for always making this possible and making this happen. Thank you. Until next time, I remain yours truly, Paul Businge, your financial wellness advocate. I'm out.